almost ready to go. Okay. Perfect. Hello, everybody. Welcome to the session. Today is April 28, 2022. This is Jose Blasco. A pleasure to join you in today's Tiger Live session, which is our session. I love it because it's SMARTT, isn't it? It's the special market analysis report for Tiger traders. So let's be smart in today's session. Let's learn a lot about the markets, about options, and all of the above. Before we get started, I'd like to let you know that I am watching both the YouTube channel as well as the app. I'm watching at those chats. So as you guys type, I'm going to be able to grab your questions. And therefore, I need you guys to be engaged, to be interactive, to be open, to work with me so you can learn more during the session. Please do not be shy, okay? And therefore, just to test that everybody is with me on that, go ahead, please, and send me a quick hello message on the chat box. So I see that all is good and I can recheck and reconfirm that I'm reading those messages and all is good to get started, okay? So please do that. Also, as we start, I just wanted to point at the upper side of the screen where we have our disclaimer. So this is something to read carefully. Obviously, sometimes it's a little boring to read those disclaimers, but they are important information. Financial markets are a serious thing. Those disclaimers are indeed a serious thing, and I'm counting on you guys to read it completely, okay? Good, perfect. Okay, so let's begin the session for today, okay? So we're gonna be going through a very quick introduction, just in case you are new to the sessions that I run from time to time here in the Tiger Brokers community. I'll just introduce myself very quickly. Again, I'll keep it very short because again, the market is the protagonist and you, not me. So we'll be talking about that. Then we'll look at key headlines. Today is a very important day from an earnings point of view. It's actually going to be fun. You probably know the things that are happening out there in the world with Twitter and Mr. Elon Musk. Guess what? Today, Twitter is reporting earnings, and that should happen in 24 minutes from now. So we're going to be able to see it live as the session is actually progressing. Okay, so a nice one. So we'll talk about this. We'll have an options lesson for the day, a special market commentary, which is the title for the lesson for the session for today. And then also keep in mind, I have a bonus for you, which I'll share in a moment. Talking about bonuses on the screen, as you can see, there is also a QR code from Tiger Brokers. This is a zero commission card. Make sure you grab it so you can do your options trades at no cost. I guess it's a nice one. Thank you very much, Tiger Brokers, and don't miss it. Okay. And finally, Q&A. As you can see on my list, I have it at the end. Well, while the Q&A is at the end, I would like to welcome you to ask questions anytime during the session. I'll be monitoring the chat boxes, as I said, all of them. So no matter if you are on YouTube or you are in the app, just make sure you are interacting with me. And if the answer is coming later, let me be the one to tell you. But if you have a question, do not keep it to the end. Just type it any moment you have it, okay? So that way the session will be more useful to you. So my name, Jose Blasco. Again, I am a multi-asset trader. I trade all assets. Options is my favorite by far. I love options all the way. And well, I trade all the markets. Options is what I do the most, okay? One of the reasons we can do many things with options. I normally always kind of joke and say options give you options. Sounds funny, but it's a serious thing. It's true, actually. You can do many different types of applications with options. We are taking advantage of those Tiger Live sessions since a while ago to go over and run some, let's call it foundational options lessons, mini lessons at times. What we are doing little by little is building a base. So it's going to be a moment in time where I'm going to put together a collection of strategies that you're going to be able to employ, learn from it, apply yourself. And, you know, all those strategies are going to be, believe me, quite powerful. But the danger with options is that there are many options, and therefore many people jump too soon, combining too many things together without having proper control of what they're doing. and then they get in trouble and they wonder why. So I want to make sure that in these sessions, we build a very strong foundation, a very strong base. So options trading becomes your ally for the rest of your life. And that's why I'm asking you to collaborate with me on the chat boxes, okay? Even if it's just a simple thing, just like saying hi. But, and then of course, the most important things such as, having questions or giving me answers. If I do like a mini quiz, or I want to double check that you got whatever concept I told you today. So please work with me on the chat box, okay? That's extremely, extremely relevant. Anyway, our company, tradewithufos.com, also known as Tradictive, okay? Tradictive is the engine behind tradewithufos.com. So why trade with UFOs? Well, because we use UFOs to trade. And what are the UFOs? Well, they are on-field orders in the market, UFOs, on-field orders, and they look like flying saucers on the chart. You will see that later. I'm going to be using real-time charts. I'll use a few slides, and then I'll move to the real-time price charts. And that's absolutely critical in my mind when it comes to defining your entries and exits when you trade, no matter if you use options or you don't. Options are great, but if you enter too soon or too late, it's a problem, just like any asset. So the timing of the trades, when to get in, when to get out, entries and exits, it's obviously critical on top of the various strategies that we could employ when trading those beautiful options, okay? So we do a lot of things like that on our website. I welcome you to go take a look. And certainly you'll find useful content, including tools, including certain things that are free actually. So go take a look. Anyway, let's begin with headlines for the day. So if you have been in my sessions before, you know I am very pragmatic. We could get into a conversation about news and spend 2 hours talking about the world and the news and the financial markets, and that's certainly an interesting conversation to have. But as a trader, I like to be very pragmatic and go straight to the point to what matters, if it matters. Okay, because sometimes actually there is no news. Okay, and that's the news, no news. Well, at this moment in time, of course, we all know that there is a situation happening in Russia, Ukraine. Not a joke. There is also a situation with the US fighting inflation. If anyone here is watching the currency markets such as Forex, but also currency markets such as cryptocurrencies. So if anyone is watching, okay, or maybe trading too, you have seen that in recent times, the movements are no joke, okay? And this has a lot to do with a lot of monetary policy where the US is trying to fight inflation. Many countries are modifying, or there are rumors of countries modifying interest rates, and that is creating an impact. Okay, it's creating an impact. And in this case, for example, you can see the market falling, and you're like, okay, the market has been falling during the past few days. Okay, it's falling. But guess what? There are other markets such as the dollar, or for example, the euro has been falling. So if the euro is falling, the dollar gets stronger. If the dollar gets stronger, you need more dollars to buy whatever is it that you buy. So then people stop buying, and therefore what happens to the markets? They fall. So again, it's all connected, and obviously the headlines we are talking about are impactful in that sense. They move the markets, okay? The third item on my list is Mr. Elon Musk and Twitter. I guess most of you, probably all of you, are aware about the news that everybody's talking about. Obviously, there are certain businessmen in the world that when they say something, they impact the market and the world. You can be thinking of Steve Jobs when he was alive. You could be thinking of Bill Gates. You could be thinking of Elon Musk, for example. Of course, there are a bunch, obviously, of extremely relevant, personalities out there that, apart from very smart, actually they are very impactful given their fortunes, the companies they have, and everybody's watching what they say, right? So, with the Twitter thing, to be honest. I'm not sure if that's relevant or is not that relevant from a company acquisition point of view, but that doesn't matter. What really matters is the perception of it, and the perception indeed has been moving the price of Twitter, which, by the way, reports earnings today in 15 minutes. And on top of that, if you look at the price of Tesla, well, Tesla is a car company which is not related to technology or social media. I mean, it is a technology company because there are electric cars, but it's not related to social media. But in the end, there have been pretty massive movements in both of those companies. And again, these kind of news are often the beginning of something. right? The beginning of something, or maybe a big surprise in the market where, something that was not likely going to continue, next thing continues very much. So we need to see what's going to happen. The following days, the following weeks, I think are going to be very interesting to watch, to see how the market defines itself. If you recall the market analysis I did the last week, I was actually quite wrong. We're going to go back and take a look, and maybe Mr. Elon Musk is to blame. We'll see the charts in a moment, and we'll comment on that. But again, it's going to be very interesting to see the market define itself, because probably we are about to see either a continuation of the move to the downside, which is pretty intense, or a complete change of direction, probably also with a catalyst of whatever earnings for Twitter can be today. Okay, so something to watch. You can see today, if you look at the list of earnings, normally I don't spend too much time on this slide, but look at the names: Twitter, Apple, Amazon, Intel, Philip Morris, MasterCard, McDonald's, Caterpillar, Merck, Gilead Science, Comcast, Western Digital. So all of those are extremely relevant companies that belong to different industries, by the way. And all of this is being reported today, just like in the prior days, they were also very relevant earnings. So again, the following 2 weeks are certainly very impactful, and will help the market to define itself. I would say even beyond the war and the inflation situation, because I think that this is something that has been digested by people for a long time already. And let's face it, while it's sad to say, the markets sometimes, most of the times actually, they end up tending to be a bit cruel, if you wish. And even though there is this war happening, which is an extremely sad situation, well, the market will react to it, but then the market will tend to forget about it and just do what it has to do. This is what happens all the time with the markets. The markets are kind of bigger than whatever it is. Okay, even the pandemic, the market did what it had to do, and 1 month later, the market was kind of back where it was before the pandemic started. So, yeah. That's what it is. Okay, so again, very interesting week in front of us for us to watch and observe. Okay, cool. Eric, you said really, and I just missed it there. I don't know exactly what is it that I said when you typed really. If you don't mind to rephrase it so I can comment further, because right now I just saw your message. So let's begin with our lesson for today. Today we're going to talk about the VIX. Okay, the title for the lesson is "Nice to meet you, Mr. VIX. Do you think something will gain or lose value?" Okay, and if you recall last week when we went over our lesson, and if you missed it, all of those lessons are recorded. So go catch up either with the Tiger Broker apps or with the YouTube channel. So watch it, because it was a very relevant lesson, a lesson on implied volatilities. So we know that options change value based on things other than the price of the underlying asset, right? Of course, the price of the stock, the price of the underlying asset, indeed impacts the price of the options contracts, calls and puts. But there are things other than that that also impact the price of the options, and we measure that in multiple ways. And one of the key elements that we discussed last week was the impact of implied volatility and the importance of knowing more about implied volatility not to buy an option that is too expensive. So when the market moves, you end up making no money because the option that you bought was already expensive. So if we take the market humongous movements for that expensive option to start producing some returns, and the problem is that you bought it too expensive, or vice versa. If you sell an option which is way too cheap when you sell it, because it's so cheap, so it's not like you're not gonna make much money with it because it was already cheap when you sold it. Okay, so implied volatility was a key element, and we looked at the CIV, the continuous implied volatility, which was real time. We talked about it for individual securities, individual stocks, individual ETFs. And again, we have the lesson out there for you to watch. Okay. Eric, is it a good time to buy the VIX? Okay. Well, we're gonna analyze the markets, and as I go through the lesson, I'm gonna move into the charts, and I'll comment on that. Okay. But the short answer is, I would say no. Okay. It's actually, the VIX is very likely going to fall more than rally. But again, we're gonna see that on the charts, and I'll explain why I get to that conclusion. Okay. Very nice. Perfect. Okay, great. Good. And also, I can see a few more of you that joined the session, guys. So if you don't mind, just type a quick hello on the chat box, okay? Unless you are driving, okay? Go ahead and type a quick hello. That would be very nice of you. So anyway, so let's talk about the VIX, because the VIX, okay, is also an implied volatility measurement. Okay, and you're gonna be like, okay, so then what's the difference between what we covered last week? Well, that's what we need to learn, because Mr. VIX is an important person for us to know as options traders. Okay, so let's talk about what's the VIX. The VIX is an implied volatility index. That's what this is. It's an implied volatility index. And it's an implied volatility index made of what? Well, it's made of the individual implied volatilities that corresponds to the 500 stocks that make up the S&P 500 index. So the S&P index is made of 500 stocks, which are the 500 greatest stocks in the US based on market cap and so on. So when you take those 500 relevant companies, they are optionable. They have options. So when you look at the options of those 500 companies, they all have a specific level of implied volatility. Some options may have a volatility. For example, you look at McDonald's. I have no idea real time now, but maybe they have volatility of 21. Maybe you look at Intel, and maybe it has volatility of 55. And again, those volatility measurements, okay, they are individual for each one of those 500 stocks. But if you take it and you create that index, which is a weighted average, okay, it's a pretty complex mathematical calculation where you're looking at 3 strikes above and below the at-the-money price in the front week and the front months and the next month's expiration date, and then it's weighted times delta. Again, I don't want to make it too complicated. Let's call it a smart mathematical calculation that takes the implied volatility of those stocks and then creates this weighted type of smart average that is the VIX. And therefore, now you can have a measurement. Yes, absolutely. A very important, Echo Whiskey. Yeah, absolutely. Very, very important lesson today. Okay. Option. Oh, it looks like. Oh, okay. Now I see. It was the video stream was frozen for whatever reason. Yeah. We cannot be an options trader without understanding the VIX. Okay. So it's a very relevant lesson today. RC, a bought call option. Which type of trading should choose for set auto trigger gain and lose? Okay. Coming to that in a moment. Let's complete the lesson first, if you don't mind, RC. Keeping that in mind later, I'm moving to the real-time charts and I'll address your question, okay? So again, the VIX is important because when you look at the chart of the VIX, which we have an example right now on the screen, right? So when you look at that chart, basically you could see if you are in the upper part of these chart candles or you are in the bottom part of the chart candles. Furthermore, you have the UFOs on the screen. So you have green UFOs below, red UFOs above, which tell you what cheap is for the VIX and what expensive is for the VIX. So think about it. Let's say the VIX drops to where the green UFO is, which is currently at the time of the screenshot, it's pointing at 17.81. Well, if the VIX is pointing at 17.81 as a cheap value for the VIX, and the VIX goes down to that low, it means that as an average, the 500 stocks that make up the S&P 500 index as an average, they have cheap options. So what happens when something is cheap? Typically will tend to become more expensive. What happens when something is expensive? Typically will tend to become cheaper, typically tending to a mean price. Okay. When you look at the chart below, you can see this is not like a trending chart. Okay. The VIX is normally not a trending chart. I will show you that real time in a moment. The VIX is probably something that ranges. Okay, and the range can be wider or less wide depending on market cycles, but typically it ranges. And you have what's high and you have what's low, and typically the VIX goes up and down from low to high and high to low. So imagine if that VIX was to drop to that green zone. That means that the majority of stocks in the S&P got cheap options. So you buying options would be a very good idea, putting on the side your trading methodologies and the type of strategies that you use. But in general, as a generic statement, buying options, buying calls, buying puts, and other combinations where you are buying, those buys are smart. Why? Because you are purchasing cheap options that will tend to gain value somehow, even if the stock starts moving against you. I mean, if the stock starts moving against you, the options will lose value, but there will be some gain out of the VIX reverting back to the mean. So the benefit here is that even if the stock goes against you, you may lose less than expected. Okay, if the stock goes against you, typically you lose. But thanks to the VIX going back to the mean and you purchased very cheap options, so now you are losing less than expected. You have some gain, in that you have some intrinsic value. You have some extrinsic value gain. The opposite is true. Let's say the VIX rallies all the way to the value 30 something, those red UFOs on the chart. Well, you would want to be a seller of options in general, because that would denote that the majority of stocks on the S&P 500 index are now providing overpriced options, expensive options. And obviously you don't want to buy expensive options. We talk about what happens when you do that, right? So you want to sell expensive options because not only time passes will decay them, but on top of that, because you sold them at an expensive value and they will tend to revert back to the mean. So now you are benefiting from two forces working in your favor, which is the price of the option shrinking because the VIX is falling, plus time decay also helping for that shrinkage. Okay, so again, very relevant. Could you ignore the VIX and just look at the implied volatility of stocks individually? Yes, you could. But just like you could go ahead and buy a stock just because you like the company, you could. But you guys tell me, and please type it on the chat box. What is a smarter action to be taken as a trader? To buy a stock just because you like the stock? Or to buy a stock as you like the stock, but in a moment where the whole S&P overall is actually moving higher in an uptrend, and the sector that stock belongs to is also very bullish and very strong, and you have all those supporting forces supporting the stock? Well, please type the answer in the chat box. I would say it's kind of common sense, but I'd love you to type, what you think. Buy the stock just because you like it, or buy the stock as the S&P and the sector is also working in your favor. What is a better choice, number one or number two? So please type 1 or 2. So, well, I guess as you are typing, I guess that the second scenario obviously is more powerful. I guess it's common sense, right? So same thing now with the options. Think about the same concept I said about stock shares, now apply it to options contracts. When is the best time for you to buy a call, for example? Well, you want to buy a call when the stock is in a good place for you to buy the stock. So instead of buying the stock, you buy the call. That will make you money when the stock rallies. Great. But on top of that, if you were to buy the call when the VIX happens to be low, you would now be buying a call that is likely going to gain value, even if the stock happens to be moving to the upside very slowly or even a little bit against you. That call still may gain some value thanks to the VIX going back higher. So the VIX, it's a catalyst for the implied volatility of your options to move in that direction, just like the S&P is a catalyst for your stock shares to move in that direction as well. So again, you could ignore the S&P and you could ignore the VIX, and you could certainly trade, but you would probably very likely be a better trader by not ignoring the S&P and not ignoring the VIX when doing your market assessment. Okay, that's why we are discussing about this. Echo Whiskey, you want to buy the stocks you want. Okay, yeah, I'm with you. That's why the market is made of many people with different decisions, isn't it? In my case, I'm picky. Okay, and there is a price to pay for being picky as well, which is I may trade a bit less. Okay, so everything in life and trading got pros and cons. But yeah, anyway, that's my choice. Okay, so anyway, now let's continue. Every stock has its own implied volatility level. We often see divergences where a stock may have high IV when the S&P is low, or vice versa. We should always be aware of how overpriced or underpriced the options we plan to trade are. This is what we covered last week. But a very powerful application is to add some VIX analysis to the mix, which is what I am proposing to you today. When the VIX is low, ideally, when the VIX is entering a green UFO, most options will tend to increase their value, and therefore you want to be an options buyer. You don't want to sell options when the VIX is low, because not only you collect very little premium, that's already a problem by itself, but on top of that, when the VIX is low, the VIX is likely going to go back to the mean and therefore gain value, and therefore the options you sold are gaining value, which is a problem. When the VIX is high, ideally when the VIX is entering a red UFO, most options will tend to decrease their value. So you want to be a seller of options. You sell options at an expensive price, and that will put you in a good position. You don't want to buy options when the VIX is high, because when the VIX is high, it will tend back. It will tend to go back down and therefore back to the mean. And if the VIX goes back to the mean, typically the options prices will shrink, And you as an options buyer, you will find yourself having bought a call or a put that is now deflating, and you are not profiting even if the stock is moving your favor. So again, something to add to the mix to make your options trading more accurate. Okay, so I'm going to move to the charts. Okay, we got 2 minutes for the Twitter report. We are perfectly on time. Before I move to the real-time charts, I wanted to share this QR code for you, this link as well. We run live trading sessions non-stop on our website, tradewithyourforce.com. There is a small fee to access those live trading sessions where you could learn a lot about options trading. But again, being part of the Tiger Broker community, we have this special link for you where you can get access for free during 3 months. So just go ahead and click on it, fill in your information. You will not be prompted for credit cards or anything. Just sign up. And then actually today at 11 p.m., I am doing a live trading session with options where beyond talking about market analysis, I'll actually be executing trades. Okay, so you can see me do that, and you can see the calendar on our website too. Okay, so join us. I'll be delighted to find you there. Cool. So let me stop sharing here. So I can now change the sharing on my screen and move to sharing my trading platform. So here we go. I believe I should have done that correctly. I think so. See, I'm just gonna wait a moment to confirm. Yes, I believe so. Great, perfect. So here we go. You can see here the movement of price, which is currently happening with Twitter. So all this price action. Okay, this is a 5-minute time frame. Okay, this is a 5-minute time frame. And all this very violent price action that is happening at this moment in time in front of us, it's out of the earnings report. So if I look at Twitter, this is the chart of Twitter. And if I put my mouse in my earnings little button here, it says that the Twitter report is today on April 28th. It's happening before the market open. Okay, it's happening at 8, which is now. So I'm just gonna be moving to the 5-minute time frame, and as you can see, there are pretty violent movements that are happening at this moment in time. Okay, of course, the earnings report is going to take a little bit of time because there is a person who is going to be doing the presentation and the talk, and it's going to take a while. And therefore, I'll come back to this chart a little later and see exactly what's happening. But I would expect lots of movement here in a moment, and we'll see that later. Okay, but again, coming back to the VIX, just to complete our lesson, and then we're going to jump into the market analysis as well. So I'm just switching the chart symbol to the VIX. I'm going to show you a very long-term time frame chart of the VIX. Okay, so this is the VIX in a monthly time frame. So you see what I told you about. This is a thing that ranges. There is high and there is low for the VIX. Okay, if you look at it in a weekly time frame, for example, this is how it looks like. So you could tell in the last market cycle, 30 something is high and 15 is low. Okay, and you can see that every time it goes high, it goes back to the mean. Every time it goes low, it goes back to the mean. Every time it goes high, it goes back to the mean. And it keeps going like that. Low, high, high, low. And that's what's happening all the time. That's why when the VIX is high, like today. Okay, interesting. I see the screen being blanked. Not sure why that is. Let me stop sharing the screen in case the problem is on my end. Oh, no. Okay. Now I see the screen is working normally. Okay. Not sure what just happened there. But again, I am resharing. Okay, just bear with me. I'm resharing now. Cool. So as I was saying, you can see how the VIX ranges from these higher values to these lower values. Okay, and if I look at it in a daily time frame, you can see it more precisely. And look at what's just happening right now at current price. We just got a red UFO on the VIX, which is telling us it's expensive. Okay, so it was Eric 88. You were saying a good time to buy the VIX. Well, I would say no. I mean, could it keep going higher? Of course it could. Anything could happen in the markets, but from a statistical probability point of view, no. Look at what's just happening on our screen. We got sell on field orders on the VIX. So there is a lot of options selling at this moment in time. Okay, so if I even look at a lower time frame, so you can see, you can see what happened. Okay, that was yesterday. The price came into the UFO. Okay, we were actually conducting a live session yesterday on Wednesday as well, also at 11 p.m. And we were talking about it with our community in our website. And the VIX started going lower. So yesterday we were positioning ourselves as options sellers. And guess what? Today too, because while it's less high compared to yesterday, look at that. A new set of on-field orders is coming in. Again, the VIX is more likely going to fall than to rally, and until it drops to at least, like 55 or something like that. 25 or something like that. Typically, that VIX will continue falling. Okay, so keep that in mind. Again, as part of your analysis, for example, if today I had 4 choices, let's say I am a new options trader, and the only thing I know how to do is either buy a call, or buy a put, or sell a call, or sell a put. Guess what? I'm just gonna focus on selling calls and selling puts. Why? Because the VIX is high. Is that making sense? That's kind of like the lesson for today. Okay, but anyway, quick look at Twitter one more time. See what's happening with Twitter. Yeah, so volatile, going down, going up. So again, probably they are speaking now. They are reporting the earnings. So we'll come back to see this later. And what I'm going to do in the following minutes is I'm going to go over the SMARTT report. Okay, where we're going to be looking at the S&P and looking at the climate, the implied volatility, options data, UFOs to do our analysis. Okay, so we'll start with market climate and cycles. So on the left, we have the S&P. This is a daily time frame of the S&P. We can see we are in a down climate, 4 out of 2. Okay, so this climate has been falling very violently. We have reached levels of 2.05, where statistics suggest that too far is 1. We double that. That's how violent the move to the downside has been, which has a lot to do with changes in the currency markets, as I was saying earlier. So very violent move, okay, which is statistically unsustainable, and therefore this market is likely going to move to the upside. Okay, yesterday with a very high VIX, with very expensive options, and the market in such a position, in the live trading session, we were positioning ourselves to be long. Okay, the last week, just to comment, if you recall, we were looking at a condition where the market may change to blue, and if the market had changed to blue, we were expecting, okay, an up climate for at least 7 days. Guess what? It only took 2 days to go back to red. So that's why I said earlier in the presentation, I was quite wrong on my analysis. I mean, wrong. It's not like I have a crystal ball. I was right on applying my rules, but I was wrong on what ended up happening in the end. And again, it has a lot to do with changes in the currency markets, which impacted equities. Okay, so we need to be aware that even when you use very advanced tools, we need to use stops, we need to use hedging techniques, we need to use contingency plans. So when a market moves against you, you know what to do. You can mitigate the risk and get out for a predefined loss instead of hoping for the best now, and now maybe the market falls 20% and what, right? So we always need to be prepared to take a profit as well as to taking a loss. But with all of this said, we are back to a market condition, 4 out of 2. 4 is more than 2, so that's not sustainable based on statistics. 2 is more than 1, so that is not sustainable based on statistics. So again, we should see this market go higher. Okay, that's what the analysis suggests. On top of that, talking about options data, below you can see the blue line above the gray line, which the blue line, if you recall from last week's lesson, it's the continuous implied volatility for the calls, where the gray line is the continuous implied volatility for the puts, which in this case you can see the calls are winning the battle, and therefore there is a bullish sentiment building up from behind the scenes. Probably many smart traders are looking at the market falling so hard, and they're like, okay, I'm just going to load my account with shares. Smart action to be taken, but for sure, be prudent. Loading your account, it's probably not a good idea. You always should have a controlled size of your trades, where worst case, you know how much you're going to lose if things go bad, okay? Instead of just all your money is in one stock, okay? That would be quite reckless, okay? Anyway, so not too much happening on Twitter yet, okay? Not too much happening on Twitter yet, so we'll keep watching it. But let's continue with our market analysis, okay? We will talk about the implied volatility of the calls and the puts. So let's look at the volume map now, okay? So let's take a look at the volume map right here. So what do we have with the volume map? Okay, so we had yesterday surpassed the average volume for the calls as well as the average volume for the put. Both were surpassed. So from an options angle point of view, we didn't have much clarity of who is winning the battle. if we were to look at ratios, we got 1.7 times, 1.9 times, 1.5 times more puts traded than calls. How do I know? Because it's gray color. Blue is call, gray is put. So the puts were winning the battle, but because the gray line is below the red, it means that many people were selling puts. Okay, many people were selling puts. That 1.7 times more puts than calls traded, they were being sold, not called, not bought. And therefore, again, that's a bullish action to be taken. When you sell a put, is because you expect the stock to go up. And in the end, you may want to get the stock put to you at a lower price, very smart. But you sell the put because in the end, you are bullish. You may not be bullish at the current price, but you are bullish. So there is a bullish sentiment building up behind the scenes. This is confirmed by the volume map as well as the implied volatility comparison, as you can see. What else? We have the UFOs. So let's take a look at the UFOs. What do we have? What should we expect for the market? So this is the S&P futures. So in the futures markets, just a few minutes ago, this is a 34-minute time frame. So a few minutes ago, in this 34-minute time frame, we got on-field orders to sell. Okay, we got on-field orders to sell. So if the market was to go up, we should expect it to go down. But if it goes down to this price, we got on-field orders to buy, and from there we will expect it to go higher. So we may see a little bit of a zigzag of price movement as the market opens today, unless something absolutely crazy and magic is happening with those earnings, like Twitter, Apple, Intel, and very massive moves are happening in drivers, such as those stocks. And then, basically many of those on-field orders are canceled, opening up for a lot of speed of movement, either up or down in the market. So this is to watch right at the open, especially in days like today with so many earnings. But if everything stays equal, so again, we got on-field orders to sell on the SPY ETF, which are likely going to push the price lower. We got on-field orders to sell on the S&P futures. So again, I would not be surprised that right at the open, we have a little bit of a movement to the side, to the downside, just to see the market go back higher. Okay, this will be my expectation, putting on the side that earnings could obviously create an impact. Okay. What else? Well, we also have the open interest map. So again, more options data for our analysis. Okay, the SMARTT analysis. Okay. So what do we have? Let's look at the open interest, okay? And we're looking at the open interest, okay? This strike catches my attention. Okay, that one catches my attention. That one catches my attention. So we are talking about 415 and 420. Okay, those are very likely relevant support and resistance points in the market. So the market is currently trading pre-market at 422. I just said 420 seems like a very strong resistance, but price is above that. So when price goes above a resistance, the resistance tends to become support. So and we said 420. Let's take a look at the futures. Well, 420 is more or less here. Okay, between 422 and 422 in the futures. The futures and the S&P are not exactly the same prices, but it's more or less there. So there is a support at this price point, which coincides with a green UFO. So again, I would be quite inclined to expect the market to go up, go back down. And then from there, we have an update today starting out of that UFO. Okay, that's very, very likely the type of market setup that we're going to see. Okay. Again, all of this is out of my experience, rules, trade plan, and so on. Okay, I could certainly be wrong. And every time I trade, and I suggest you to do the same, you should have stops, you should have techniques of risk management in place. Implied volatility, okay, when it comes to expected price movement, expected speed of movement, price projections, okay? So take a look that last week when we were meeting, the red line was within the blue lines. Options were cheap. The expected range of movement was equal or less than the price at which the S&P has been proven to be able to be capable of moving at. Well, guess what? Today, the red line is beyond the blue lines, which means that the implied volatility in those options contracts suggests that the expectation for the move is greater than the speed at which the stock has been moving in the last 1, 2, and 3 months. We got 3 blue lines as you know from prior sessions, they represent 1, 2, and 3 months of historical volatility. So the red line suggests there is an expectation for the market to move faster than the speed at which it's moved in the last 3 months. That's why options are expensive, okay? That's why the VIX is 30 plus, okay? You get it? It's all related in the end. And finally, before we conclude our analysis, we got sectors and groups, okay? So if I look at the grouping in the market, we won't have too much different here compared to last week, okay? We can see consumer goods, utilities, and telecommunications are sectors that show more strength than other. If we look a little bit at a longer term type of approach, okay, we are also looking at consumer goods, which is strong long-term and short-term, utilities, long-term and short-term, telecommunications, long-term, even though it looks like it's weakening in the short-term, okay? Oil and gas, weakening in the short-term, strong in the long-term, and so on. So again, it seems to me that sectors like, for example, consumer goods or utilities are probably the sectors where the best opportunities in the markets are going to be found. So you can get into consumer goods, for example, look at food products, seems to be in a very bullish trend long-term, a little bit of taking a breather in the short-term. Tobacco, which seems to be gaining momentum, and most importantly, also in the long-term. Beverages, seems to be quite stable with a strong momentum long-term. So again, all those sectors are indeed valid for us to observe, and depending on your trading style, maybe you look at fundamentals, and because technically speaking, tobacco is strong, maybe you go check fundamentals on tobacco companies and you go decide to buy Philip Morris, just to pick one, okay? So again, just giving you a bit more visibility of what's happening from a group and sector point of view. With all of this said, I'm going to go back to the chart of Twitter to see if we've got a bit more movement. Okay, so far still kind of like the same. I guess the report is still being delivered. Not sure if that number has been published already or not. But again, you can see how this movement is happening. And again, this is, I am utilizing pre and post market data, or actually pre-market data in this case. Okay, I am looking at all sessions on my chart. If I uncheck all sessions, notice how those candles go away. This is where Twitter closed yesterday when the market closed. But if I look at all sessions, now we can see what's happening as the earnings report is being reported. And you can see that there's been a pretty interesting volatility spike. Okay, so again, let it be probably in half an hour from now, the whole report and reaction will be done. And we may have Twitter, I don't know, 2%, 5% higher. We may have Twitter 2%, 5% lower. We'll see. Certainly something to watch. And if you're new to reports and all of this, it's a pretty nice one because, with everything happening around Mr. Elon Musk, and it's happening today and we're meeting today. So nice coincidence. My friends, I am done for today and I am perfectly on time today. This is amazing. 45 minutes. Thank you for joining me. If you have any final question, please let me know. Do not forget to use this QR code and join our coaching sessions. You will benefit greatly from it because in the end, knowledge is an important piece of the puzzle for you to trade well. Hopefully, I shared some knowledge with you and now you are wiser. That would make me very happy and hopefully you are happy too. But now getting serious, apart from being wise or being knowledgeable, you gotta develop a skill, and that is done through repetition, and there is no better way to look over the shoulder of a trader. So, and then practice yourself, okay? So in those coaching sessions, we plan trades. Often students will execute the trades in their paper money accounts. Some will do it with real money. All of that would be your decision. But certainly in those sessions, you are welcome to ask questions. We explain the rationale of why we plan the trades the way we do. And you will learn a great amount about options trading. And again, you have free access now. So join me there. And again, I do it today at 11. Okay, I do it every week, but today at 11. So if you're a passionate options trader like I am, don't miss it. Join me later. My friends, thank you. Thank you, Tiger Brokers, as well, for supporting the session and supporting the whole community, and also us as one of your partners and company, which we are just as passionate about you all when it comes to trading and the options. Okay, so you guys take care. See you next time. I will see you again on, apart from tonight at 11, I will see you again on May 16 in the Tiger Broker community. So see you in a couple of weeks in here, and see you in 2 hours plus in our room on our website. Take care, everybody. Bye-bye.